Hi, this is the Philosophical Angle program, and I am your host, Chris Angle. Along with me is my co-host, Rick Samuelson, and today is a special edition of the Philosophical Angle in that we take a look at the stock market and see what's happening. And we try and make our guesses as to what's going to happen in the future. We do this by taking the RITE report, and that's spelled R-I-T-E, report. And you can see that online. And it takes the Wall Street Journal headlines and makes positive and negative, and we cut and paste it into a journal, and we make an index out of it and see where the news is going, and if that leads us or gives us clues as to the future of the direction of the stock market. So today in February of 2016, we're going to take another look, our monthly look at the stock market and the news that has been coming to the investors and possibly driving the direction of the market. So we're going to bring up the RITE report here, and we'll make an analysis of the RITE report. Takes all the business corporate news from that's negative and positive, and it adds them up, as we explained earlier. The total of the negative corporate news snippets this month hit 44. Of course, as you can see here in the last part of the month, Chevron, Phillips 66, PetroChina, Valero, a lot of the energy companies have not done well as of late because of the diving price of oil. Now the positive corporate snippets, let's see how many of those have been presented in the journal. We've got 44. And other industries have done well, and there are some industries that have done very well because of the lower fuel prices, such as the airlines. Here's one on the 29th of January. American Airlines profit soars, propelled by lower fuel prices. Car companies are doing well. Ford posts a $1.9 billion profit. As we see here, in January, 51% were positive and 49% were negative. Pretty even. And now we go to the political and macroeconomic risk portion of the RITE report. The negative economic and business snippets. There are quite a few, but we should take a look at some of the more important ones. Here's a very important one. The U.S. industrial production dropped on declines in mining, utilities. Industries pulled back 0.4% in December. And U.S. retail sales fell 0.1% in December. Other noted headlines: German industrial output also drops unexpectedly. Here's an interesting one. Declines in industrial production, corporate profits, stock market typically point to contraction. But this is interesting. Right after that, in the headline on the journal, it said, but not always, and this may be one of those times. Well, hopefully that's true. But industrial production and corporate profits are key indicators of the future direction of the stock market. So that's why this went into the negative side. So the total of the negative snippets were 17. And let's take a look at some of the positive snippets this month that came into the Wall Street Journal. Let's go to some of the more, what I think are more interesting. Economists see continued U.S. expansion, heightened global risk. 79% of the respondents say the U.S. is exposed to risk of reduced trade through its financial markets. But overall, they see a continued U.S. expansion. Holiday sales rose 3%. E-commerce sales rose 9% for the holiday season. New York City property values have surged. Building permits are up compared to a year ago. Well, no, not compared to a year, up from December. From a year ago, December 2014. Real average hourly earnings increased 0.1% in December. And Canadian retail sales posted a surprise 1% gain in November. And let's see what else. Real gross domestic product. Okay, it's still increasing. It's not contracting, so there still is growth, but it's minimal, only 0.7%. So the total of the positive economic news snippets were 26. And the merger acquisition snippets were pretty good, pretty healthy at 24. So the positive were 60% compared to negative. Negative were 40%. So that's a pretty good indicator. It's pretty positive. However, if we add up all the indicators that we use to take a look at the economy, it didn't do too well this month. Although GDP is positive, it's minimal, 0.7, as we've already mentioned. Unemployment is still positive. The unemployment rate is at 5%. And the civilian labor force participation rate increased slightly to 62.6%. So the labor market is it's positive. All the indicators are showing positive. Industrial production, as we've already noted, is negative last month. It ticked downward. Purchasing Managers Index is also negative and shows that the economy is actually contracting here. This indicator, when it's below 50%, it indicates that there's a contraction underway, and that's probably due to the oil industry. Retail sales are also negative last month. Consumer spending is also negative. Personal income is positive though, and that's a big indicator of the direction of the stock market. When people make more money, obviously they're going to spend more and save more. Consumer confidence, probably because of the drop in oil prices, produced a positive sentiment. Housing starts were negative. Existing home sales were positive, up 14.7%, pretty good. New residential sales were up 10%. Manufacturing trade inventories were down though. Manufacturing shipments, inventories, and orders were also negative. Advanced durable reports were unchanged. Durable goods, that is. Construction spending is up slightly. And the quarterly financial report, really this means profits, was positive. Now, positives from current production taken from the Department of Commerce Bureau of Economic Analysis. That was negative. Profits from current production, corporate profits with inventory evaluation adjustment and capital consumption adjustment, decreased $22.7 billion in the third quarter, in contrast to a $70.4 billion positive increase in the second quarter. The Conference Board leading economic indicators were negative, but the coincident economic indicators index was positive. CEO confidence was negative, and high yield bonds decreased over the month, and so did the iShares Select Dividend, which we like to monitor. Interesting though, this is a key index that we believe in, that the Restaurant Performance Index shows that the restaurant industry is expanding. Because when people feel good about themselves and their particular circumstances, they tend to go out to eat. So the positive was 10 indicators, and negative were 11 indicators. This is way down from previous months, where it's been at 14, 15, and 16 positive. So this month made a reversal downward, and so the RITE report came out with the stocks to hold, not to add to your portfolio or to take something off the table, but to just hold your situation. If these indicators stay where they are for 2 or 3 months in a row, perhaps the RITE report will go negative. But so far, it's just 1 month of where the number of indicators has gone negative, so now let's turn to Rick and see what he's got to say. What do you think, Rick, about the future of the stock market in the coming months?
Well, I suppose the first thing I'd say is your assessment is consistent with the presentations I've heard from both UBS and Goldman Sachs. They're essentially saying, hold. It's too expensive from the point of view of capital gains taxes to trade the market, given that they view the risks are relatively muted. They're defensive, and in the face of questioning, I mentioned the fact that earnings are declining, aggregate earnings. The Goldman Sachs view is, well, that's all because of the oil and gas industry, and if you look at earnings ex oil and gas, they're projected to rise 5 or 6% this year. To my way of thinking, that's a lazy answer, because the oil and gas industry is such a large part of the economies of particularly states like Texas, Oklahoma, and elsewhere. And there are a lot of knock-on effects from the oil and gas industry in terms of suppliers, et cetera, particularly in those regions affected within the United States. So to call them out and pretend it's an outlier and not integrated with the rest of the U.S. economy is, I think, a false premise. I think aggregate earnings will again be negative this year. I think the continued strength of the U.S. dollar will further eat into profits of industrial companies in the first instance, but also companies like Apple, which recently announced that they left about $5 billion in revenues on the table because of foreign exchange related losses. So it's not just the industrial sector that's suffering, it's also high tech. So that presents a very difficult picture for the stock market, the U.S. stock market. The Goldman Sachs and UBS forecasts are for flat performance, relatively flat performance year on year, which would mean it would be up from where we are today. We're down, 6-7% year to date. So their forecast would be for some slight appreciation, significant appreciation, I should say, but not double-digit appreciation from where we are. I guess the counter argument has to be that if Goldman Sachs is correct, and at the end of last year we were in the 9th decile in terms of valuation for the stock market, then the risk of reverting to the mean has to be pretty significant. And so valuations being as high as they have been up until the end of last year, particularly for the tech industry, and many tech stocks have been battered badly in the last couple of months. It's not just, again, the oil and gas sector. Banks have been battered in the last month on the back of rising bankruptcy concerns related to the oil and gas sector. True in Europe as well. I think UBS is down about 20% year to date. Deutsche Bank is down about 30% year to date. These are big, big hits. Now you could argue that if in certain sectors the valuations are brought back into line and even undershoot, which seems to have already happened in the oil and gas sector, there's at some point in time there'll be a time to pick up these stocks. These trends don't last forever, but the risks remain. Iran is intent on pumping oil as fast as it can, so they'll continue flooding the market. So I don't see relief there anytime in the near future.
Let me ask you a question. Let me ask you a question. Some believe that the reason why stocks are going in lockstep with the price of oil recently is because that the looming decrease in profits in the oil and gas industry is to such an extent that, as you say, bankruptcies could occur, and it would be a systemic or a domino effect throughout the industry, and then affect other industries, and you could end up with a 2008 style crash and recession. Do you see that as a possibility here? I do not, because I also believe that at the same time this is due to the efficiencies put in by the fracking industry that have created a decrease in price to the extent that consumers are now going to benefit greatly, and companies as well that use oil and gas in their daily production of goods and services. What do you think?
Yeah, but I think it's broader than commodities are down across the board, with the exception of gold, I might add, which is moving pretty strongly up on the back of fear, frankly. And they're down across the board mainly because of incremental Chinese demand or lack thereof, and supplementally because of lack of demand in the emerging markets. And one canary in the mine is Korea. In January, their exports fell year on year by 18%. Now, Korea is, for China, one of its largest trading partners. In other words, Korea exports significantly more to China than they do to the United States or Europe. And for their exports to fall 18% in January, year on year, tells you there's something very, very wrong going on in China. Their demand for stuff, even finished goods, not just commodities, but finished goods of the sort that, or components that Korea produces, is declining dramatically. Now, I haven't looked at a breakdown of the Chinese import numbers, but we know broadly that on the commodity side, their demand for all ranges of the whole range of commodities has declined dramatically. But to see it spilling over into intermediate finished goods is very, very alarming. So I think the view that China's growth is going to settle in at kind of 6% this year is, if anything, overstated, and that the downside, there's still more downside to those projections. And like it or not, China, in terms of contribution to global growth, is significantly greater than the United States. I'm talking about net contribution to global growth over the last 10 years. Significantly greater than the United States.
Okay. So, in conclusion, or would you buy, would you sell, or would you hold a portfolio?
I'd be continuing to buy downside insurance of some sort. Whether it's puts on the index or selling futures forward or what have you. And I would be looking for opportunities to put more money to work later on in the year. I think one, if I were going to point to some surprises that could happen over the course of the year, and to put in perspective how really bizarre the financial situation is globally, consider this. Two of the three largest central banks in the world are now officially using negative interest rates. They've employed a negative interest rate regime. This is astonishing. Both the Japanese central bank and the European central bank now have negative interest rates.
It's amazing.
And this puts enormous pressure on the United States Federal Reserve. Because if the dollar keeps appreciating, I know it's been weak in the last week, but if the broad picture is that the United States dollar keeps appreciating, the pressure on the Fed to cut interest rates to negative territory is going to be very, very high. I think it's already accepted that they're not going to raise rates anytime in the near future, and that's just on the back of January's news, right?
Okay.
Suddenly all those increases are off the table, like overnight.
Right.
So I don't think the Federal Reserve has a strategy, actually. They're just reacting to market circumstances, and the most dramatic price increases that have been happening in recent months have nothing to do with the stock market. It's been how the U.S. dollar has moved.
Okay. All right, so
It's crushed every currency in the world. We're not going to be able to export anywhere.
Okay. So, in summary, you hold with downside protection. Okay.
Yeah.
And the RITE report is just indicating a hold. All right. So thanks very much, and we're gonna call it a day, and we'll see you next month for an update on the RITE report with our co-host Rick. Thanks very much. See you next month.
Thank you.